of the central bank. But now I show you what the world is really like, okay, which is gold is not at the top, okay, the dollar is at the top. Yesterday when I was speaking at the central bank, at lunch afterwards, the person next to me pointed out that this diagram maybe is a little bit confusing because as opposed to what I did in the first lecture, the layer below the dollar, I speak of the way in which the first and second layers are linked together through the swap lines, not what's actually on the second layer. What's on the second layer are the other major currencies. So the currencies that are issued by the Bank of Japan, the Swiss National Bank, the Bank of England, the ECB, the Bank of Canada, and so forth. So I should probably remake this slide with those currencies on there and indicate that it's the swap line between the central banks that links those currencies to the dollar. And similarly, below them, bilateral swaps, regional pooling, those are various other currencies, like the zloty would be there. And what links those currencies is these various mechanisms, bilateral swaps, regional pooling, and IMF. So the diagram needs to be redrawn. But I just point that out to show you also that this is work in progress, that this is actually my current research is on this issue of extending the money view to the international framework. So I will have better slides as time goes on. So this is an image of the extending this idea of the hierarchy of money to the global system. And I now show you some data about that, about how the dollar at the top of the system is connecting to currencies farther down. And here, in fact, I'm showing the main line on this diagram, the top one here, is the interest rate of offshore dollars, euro dollars, LIBOR, London Interbank Offer Rate, minus the overnight index swap, which is a Fed funds rate, a term Fed funds rate. So it's the domestic dollar versus the international dollar. And the interest rate on the international dollar at, I think this is a 3-month rate, yes, is higher than the interest rate on the domestic dollar. So there's a premium on the domestic dollar, that is to say. So there's a link between the international dollar and the domestic dollar that's shown here. The other charts are showing that there's a similar differentiation between the international and domestic pound, okay, and the international and domestic euro here. So this differentiation between international and domestic is in multiple currencies, but the difference in interest rates is largest for the dollar. That suggests that the international dollar is scarce. People are paying more to borrow international dollars than you would expect. You can see in the left part of this diagram, this is a longer historical series starting in 2007 going to 2017, and you can see spikes in that spread up to 300 basis points, 3 percentage points in the financial crisis of 2009, and another one here during the euro crisis of 2011-12, another spike. So we thought about these spikes as economists as an indication of disorder in money markets, that it was, you wouldn't expect that there should be a difference between the offshore dollar and the onshore dollar, because if there was, then there's an arbitrage. Borrow onshore and lend offshore and just take the difference as profit. But when there is a difference, so that's why you say, well, it must be that there's something standing in the way, that you can't borrow onshore or offshore. The markets are disordered. You can't do this arbitrage. And that's why this spread exists. And that's an easy explanation to understand in a crisis. Markets were disordered. All kinds of spreads blew out during the crisis. What's harder to understand is why these spreads are high now. We're not in the middle of a financial crisis. I looked at the newspaper just this morning, no mention of financial crisis. The spread, you can see here, in case the slide is too small for you, back in last year about this time, the spread was about 40 basis points between offshore dollar and onshore dollar. It has tightened up since then to about 10 basis points at the end of this time period here. So this is a number that moves around. It's not clear that we had a financial crisis a year ago and that it went away. So what is driving the spread? What is driving the spread is mismatches in the pattern of payments internationally. And demand for funding liquidity, which is driving interest rate spreads. And where is that funding liquidity needed? Is it needed onshore? Is it needed offshore? Who's needing it? Where in the world? These spreads are moving money around, moving liquidity around the global system. And so I want to start with this one because it's the spread in the dollar itself, the global dollar and the domestic dollar. The next slide is showing you other currencies. This is actually not other currencies, it's just the euro. The spread between the dollar and the euro. If you need to borrow dollars, there's two ways you can do it. You can just borrow dollars, okay, at LIBOR in the international markets, or you can borrow euros and then swap into dollars using the foreign exchange swap market. You would think, again, that there's an arbitrage between these. That if it was cheaper to borrow dollars directly and more expensive to borrow dollars by first borrowing euros and then swapping, people would borrow dollars and then lend them in this other way, and there would be a spread and you would make money doing that. Okay? You would think that would be the case. We call that covered interest parity. You would think that covered interest parity would hold. Again, you can see on this diagram that it did not hold in the financial crisis of 2009. It did not hold in the financial crisis, in the euro crisis of 2011 and 12. Covered interest parity holding means that these lines, which is the difference between what it costs to borrow dollars by first going through euros or borrow dollars directly, it's the spread. That spread should be zero. According to covered interest parity, it should be flat along this line at the top. Okay, but it's not zero. It's not zero. It's more expensive to borrow dollars by first going through euros. It's more expensive to get to dollars by first going through euros, and yet that spread is still 30 basis points, 35 basis points. There's a profit there for somebody who can take advantage of that. Again, this is, there are various things that are conceivably driving this, and different economists have different theories at the moment. This is something we're trying to figure out. From the point of view of this course, I'm viewing this as a liquidity spread. It's about signaling where the liquidity needs and getting money to flow where the liquidity is needed, so that people who are in areas where it's easy to buy euros, borrow euros, they're in a euro area, are first borrowing euros and then swapping into dollars, so you can see where the liquidity pressures are by these spreads. And by the way, 35 basis points is a pretty big spread. If you looked at the same number for yen, it's much bigger than that. So different currencies have different spreads there. And again, it's a global system, and to attract funding liquidity to yourself, you may have to pay more than the global rate of interest. That's what's going on here. These spreads are moving liquidity around the world. Okay. So this is sort of a frame for what we're going to be talking about, so that you see that the global character of the system is a fact, and it is creating new facts in the world, that there are these spreads that exist in normal times, not just in crises. Spreads that seem to contradict some of our most basic ideas about riskless arbitrage, that there shouldn't be riskless arbitrage, but there seems to be in this global system. So what do I take the lesson that I doubt that it is riskless arbitrage. If it was riskless arbitrage, we would have no gap. It's just there's some kind of risk that is unaccounted for in our theories, and I think it's liquidity risk, actually. This is the price of liquidity risk. Regulation is driving some of this, but some of the point of regulation is to is to force firms to take account of liquidity risk instead of ignoring it, treating liquidity risk as no risk at all, that should have a price of zero. So I wouldn't say that it's necessarily an imperfection of some kind that's driving this. Some people think that it's about default risk. There's attempts to theorize this. It's a new, the important point here is that it's a new phenomenon in the world. To see spreads like this when there aren't financial crises that seem to be a new normal. And I think that these prices are doing something for the global system. They're directing money where it's needed. They're certainly moving money around. Whether this is the permanent new normal, we don't know. We've only had this, you can see, for a little while, right? After the big financial crisis, these spreads closed up. It looked like they might going back to zero. Oh, no, Euro crisis. Okay, then it looked like almost to zero. Oh, so it looked like maybe we were going back to normal, but now it looks like no. The new normal seems to be a spread here that exists and fluctuates, but it doesn't fluctuate around zero. Okay, it fluctuates around maybe 30, 35 basis points, something like that. Okay? So that's by way of framing and getting you in the right mood to think about global money. What I want to emphasize here, first slide of the lecture, really substantive slide, is that when we talk about global money, when I talk about global money, I'm talking about what's sometimes called the euro dollar, which is the offshore dollar, the dollar that is private money. Okay, that is to say, it's the liability of a bank, a global bank. Not the liability of the Fed, not the liability of the US government. It's the liability of a private profit-seeking bank. It's a deposit account, but it's a deposit account in an offshore bank or an offshore branch of a bank. That means, because it's in a bank, it's credit money. It's a promise to pay. It's a promise to pay the ultimate dollar, which maybe is a liability of the Fed. Usually you don't need to actually pay that. It's offset through clearing of various kinds. And we're familiar with that in domestic clearing that we talked about. So there's a settlement system outside the US that operates without usually touching the US. Those are promises to pay. And they're dollars. They're quoted in dollars, not in all the other possible national currencies you might be quoting them in, which is euros, yen, and RMB. Global money is the euro dollar. And the financial center of that system is London. You've seen this slide before. This is looking at how the euro dollar system works, that it may be, and now I want to emphasize sort of the first box on this diagram, which is that it can be, the euro dollar system can operate entirely separate from the United States. That the deposits that go into these offshore banks, dollar deposits, can fund dollar-denominated loans that are also offshore, and it never goes to the United States at all. It has nothing to do with the United States. Even though it says dollars, it can be entirely in Europe, it can be entirely in non-US. So this could also be flows to and from Asia, flows to and from Latin America. I mention these specifically because to come to the end of the lecture, you will see that one of the big credit booms that has been happening since the crisis is a growth in dollar-denominated credit that is owed by Latin America to Asia and Europe. That this is where and it's all in dollars, and it doesn't touch the United States anywhere. It doesn't touch the United States anywhere. So this is global money. The price of global money is a liquidity spread. So on this slide, we've already seen two of these liquidity spreads. This LIBOR-OIS spread is the thing I was showing about management of par between these different currencies. So they trade at par in the spot market. You know, the offshore dollar and the onshore dollar trade at par sort of today. If you were making a payment, there's par clearing between these systems. But there's not par clearing in the forward market. We saw that the interest rate in euro dollars is higher than the interest rate in domestic dollars. So they don't trade at par in the forward market, and that can move around. The TED spread is another thing that people trade, which is the Treasury euro dollar spread. So again, treasuries are onshore liabilities of the government, and euro dollars are private liabilities of banks. And the last one here, the inherent hierarchy, we already talked about the foreign exchange basis swap, okay, as a price that is managing exchange rates. Maybe important to emphasize here that this isn't about a fixed exchange rate system. The foreign exchange swap is not managing a fixed exchange. It's not a par clearing in that sense, but it's managing the relative movements of these compared to the interest rates in the different countries. So it's keeping them in touch with each other, but not at a fixed rate. And in the middle, I add another spread here, which is for domestic management, but also international management, the term spread, the difference between short-term interest rates and long rates. All of these spreads are indicators, are symptoms of the balance of cash flow and cash commitments, okay, in the world. And where those balances are in balance, where they're not balanced, and so they need to attract liquidity to them, where they're balanced in a deficit direction, where they're balanced in a surplus direction, these spreads and in what markets they're showing up. In the back of your mind, when you see these prices, think what sort of flow pressures would lead to these prices, lead to these spreads, and them moving in that way. So these are symptoms, observable symptoms, every single day in financial markets. You can see these symptoms of the balance between cash inflows and cash outflows at a global level. Some of these spreads are being managed by central banks as a matter of policy, we're going to see. Some of them are managed by private banks as a matter of speculation and making profits. But there's management that is key to this. This is the issue of market making and dealers. So here I'm just saying that's what the next slide says. The management of global money is essentially hybrid, that you have private dealers that are speculating in these markets. These things are fluctuating. So if you feel that, well, there's an imbalance right now in one direction, but by meeting that imbalance, okay, I can get paid because that imbalance will reverse, and then those prices will change and I can liquidate my position at a profit. Okay? This is what I called in the previous lectures, in lecture 3, the normal crisis, a normal crisis where there's an imbalance in supply and demand, and dealers make money by meeting that imbalance, by providing supply when there's excess demand, by providing demand when there's excess supply, and prices fluctuate in order to create expected profit for dealers. These, par, the interest rate, foreign exchange rate, these are very liquid markets. And what that means is that there are dealers that are making those markets. And in general, in these markets, public actors, central banks, are operating as dealer of last resort, making the outside spread. They will intervene when the private dealer system runs out of capacity or prices move too far, those spreads get too big. And that also is analogous to what I was saying in lecture 3 about moving from a normal crisis to a serious crisis, okay, or a global crisis when you become dealer of last resort. So management of global money is essentially hybrid. It's a sort of cooperation between private and public actors. And there's a hierarchical character to this management as well. I've been talking really about the very center of the system right now, right? It's the dollar and the 6 major currencies that are connected to the global dollar. One of those 6 being the domestic dollar. So and we've been talking about the markets that are maintaining contact there. But there's more hierarchy farther down, okay? And the way, though, the connection between smaller currencies like the zloty, okay, and the euro work is not the same as between major currencies, the yen and the dollar. So I call that the spectrum of hybridity as well. That in reserve currencies, it works as I said. They're deep and liquid dealer markets, private. And the central bank is only operating as a backstop, as a last resort. But in peripheral currencies, it's really the opposite. There's hardly any private dealers there, and it's the central bank that's doing all the work. So the central bank becomes the foreign exchange dealer. And there's intermediate cases where the central bank is partly involved or the private dealers are partly involved. So there's a spectrum of this hybridity. And at the top of the system, at the core of the system, there's much more private action. At the bottom of the system, in the periphery, there's much more central bank, much more public action. The exchange rate regimes are similarly varying. I'm mentioning this just to connect up with some of your prior education. As I think I said last time, when you look in textbooks or you learn foreign exchange, often you are looking at little models that say country A and country B, and you're imagining these countries are sort of at the same level of the hierarchy, and you're thinking about supply and demand for the different currencies, and in general you're abstracting from the dealer system that is making these markets, okay? And you're also abstracting from the fact that this dealer system has a structure, that there's a private part and a public part. So it's not that the theories you're learning are necessarily wrong, but they're pretty abstract, they're pretty far away, and the lived reality of these markets is that they're hierarchical and that they're hybrid. All of these features for modern markets, I think, need to be brought into play in order to understand what is happening outside the window. So that's global money. Now I want to connect up this global money story to what we talked about last time, shadow banking, right? I said that the past, present, and future of shadow banking, and I was suggesting that I thought that shadow banking did have a future, even though some people would like to kill it, that its future comes from the fact that it's the natural form of banking for a financially globalized world. Now I kind of want to elaborate on that point a little bit, and so I'm showing my shadow banking kind of diagram with the shadow bank over there, money market funding of capital market lending, except now I'm showing foreign exchange loans, okay? That your dollar funding of foreign exchange loans, so there's a currency mismatch in the funding that's here too. A currency mismatch which you might want to hedge with the foreign exchange swap. So that just as you are hedging out default risk and interest rate risk with CDS and interest rate swaps, you might want to hedge out the foreign exchange risk so that you have a sort of synthetic treasury bill on the asset side of your shadow bank that you're financing in global money markets. So it's the same sort of idea, but now extending it globally, and that involves derivative dealers that are making markets in foreign exchange swaps here, and that involves asset managers or other speculators taking positions, naked positions in what is going to happen to that foreign exchange swap as an investment asset. You can see that it's a simple extension of the model that we had last time, where we were just thinking of dollars on both sides and hedging various risks. Now it's a global system, so there's going to be action in foreign exchange swaps to hedge these kinds of risks as well. And we should have that in mind when we look at facts like the negative basis in foreign exchange swaps, that there's a lot of action in this global banking system, a lot of risks that are being moved around that are pushing around those prices. Okay, so the things that are pushing around those prices are not just settlement, right? It's not just, it's movement of collateral, it's movement of exchange risk, trying to find somebody who's willing to bear this risk at the lowest price, and it's moving around the world to wherever the speculative demand is going to meet it. So global banking is shadow banking. And that means that management of global banking is also essentially hybrid. By essentially hybrid, I mean part private, part public. That the private part of this management of risk, so I'm showing the dealers in the center of the picture, making markets that they're important for their key players because the prices of funding and the price of capital assets are being determined in these markets. And I'm showing that they are managing their positions on their own, their profit-making entities, by managing their liquidity position by holding some reserves, managing their solvency position by holding some capital so that they can absorb some losses and they can absorb some mismatch in cash flows. Same for the derivative dealer. Okay. But that there's also another layer of support behind the scene, which is these liquidity puts and solvency puts. These are liquidity puts to the banking system possibly, and then or maybe directly to the central bank in both cases. Solvency put, conceivably, there's a private investor maybe that is offering to put in capital if they need it, or ultimately some taxpayer body like the Treasury or something. Some of these things may be written down, some of them may be implicit. You may be betting on them and then find out that it's not really true when the crisis really comes. But so I'm suggesting we need to think of the backstop as essentially a hybrid too, part public and part private. And this is going to be different depending on where we are in the world. So, any particular research focus you have, you can use this diagram, but then you need to specialize it and say, it's going to be different if we're talking about France, or we're talking about Venezuela, or we're talking about Taiwan. The application is going to have local specificity, even though it's a global system. I want to say more about that previous thing, but I put in this slide here, I thought it was appropriate to take a little break and let that absorb a while, and think about the big picture, to remember global money and global banking, where they came from, what problems they were solving, where did this brave new world come from? And in particular, to dispel any idea that this is some, conspiracy that's being foisted on us by global banks, or some conspiracy that's being foisted on us by the US government or something, that it wants to control the world with this global dollar system. The actual history is more interesting than that, actually, more interesting than conspiracy theory. What happened is, this is way too brief, but just to give you a sketch, the globalization of finance was a process. The first one step right after World War II, I mentioned, is the rise of private capital markets, and I'm indicating that its center was in New York. So the private capital markets were not really functioning during the war or in the Great Depression. It all fell apart, and they recovered first in New York, so that if you wanted to borrow long-term bond market, New York was your place to try to issue your bonds, and of course those are dollar-denominated bonds. The collapse of Bretton Woods at the end of the 1960s, beginning of the 1970s, was a key moment in there was an attempt to recreate the international monetary system with the dollar as the center, and that's what Bretton Woods did, right? The dollar was supposed to be convertible into gold, and everyone else was supposed to be convertible into dollars. So this is the beginning of global money, but it was an arrangement between nation states, and that arrangement broke down. To tell the truth, the US said, forget it. We're not going to peg to gold anymore. And everyone else said, if you're not pegging to gold, we're not pegging to the dollar. And so that's what happened. The thing seemed to break down in 1971. It seemed like maybe the international monetary system was going to really go through a period of great disorder, possibly a return of the Great Depression. This was in the mind of some people. This was exactly when Charlie Kinderberger wrote his book on the history of the Great Depression. I think he thought this might be useful to recover this ground. But it didn't happen. We didn't have a Great Depression, and the reason we didn't is that the international monetary system reorganized itself as a private banking system through the rise of the Eurodollar market with its center in London, this thing that I mentioned to you at the beginning. That became the global currency in London, and what shadow banking did 20, 30 years later, once that got going, was to join these two pieces, right? The funding system with its center in London, and the lending system with its center in New York. And by then other capital markets have grown up and so forth. So this is what shadow banking does, is it joins money and finance. This is why intellectually it's been hard for economists to understand, because our intellectual understanding of the world also grew up in pieces. Money, banking, these are courses taught in economics departments by people who are thinking about central banks and government. Finance? Stocks, bonds, these are taught in business schools by people who are thinking about speculators and stockbrokers and so forth. They live in different intellectual worlds. Shadow banking bridges these worlds as a matter of institutional fact. So the theory we need to understand the modern world requires us intellectually to bridge these worlds, to join finance and money. That's what the money view is trying to do. It's trying to be a way of talking about money that makes sense to people who understand finance, and a way of talking about finance that makes sense to people who are used to talking about money. so that it's a language that can bridge this gap and be a global money language, not specific to capital markets or money markets. So shadow banking is an integration of global finance and global money, the rise of the market-based credit system, quintessential form of banking for the modern day. And I emphasize, in red, the way we think about money and finance in this course is not as sometimes you get in textbooks. We talk about the financial sector, right? And what are the profits in the financial sector? How many people are employed in the financial sector? That sort of thing. As if it's a separate, as if it's, there's the steel industry over here, and there's the restaurant industry over here, and there's the financial industry over here. Okay, that's one way of organizing your knowledge, but you're not going to understand finance if you organize it that way, because finance is in every industry. Finance and money are the infrastructure of the market economy. Any industry that's involved in the market economy is involved in the money system, is involved in the finance system. And that's why it works for us to do money flow accounting, to think of the economy not as a bunch of hundreds of different kinds of commodities, but just as money flows. It's all money flows, all money flows. That we can think of, was Minsky's sort of idea, thinking of a factory. A factory is really just a kind of bond, where there's money inflow, money outflow, a kind of a bank. That every entity is a kind of money flow, that's what unifies the system. It's not hundreds and hundreds of different kinds of commodities, it's money all the way down. And that's the infrastructure of the market economy, and that's why making sure this infrastructure is solid and not fragile, that it doesn't break, that it's backstopped, is of public interest. This isn't about giving the financial sector somehow privileges that the automobile industry doesn't have. It's about making sure, it's like making sure that the roads work, making sure that the infrastructure of the economy is doing its job. The political economy of that is difficult because there's a lot of money being made here, there's a lot of wealth, and the hybridity, the public-private hybridity creates lots of opportunities for corruption and self-dealing. So I'm not saying it's easy to do that, okay? But I am saying that thinking of it as the infrastructure of the market economy, I think, will lead you to better intuitions about it than thinking about it as a particular potential future employer for yourself, as a separate industry or something like that. It's the infrastructure of the modern economy. So now I return to the theme where I was, global governance. So this sort of system, which has this hybrid management structure, private and public, that is managing it normally. Governance of this system, it's a global system, but we do not have global governance. So this is a political economic challenge. And maybe one of the most important political economic challenges that is confronting us at this time in history. And I'm going to be a little more specific about that, the challenge. Liquidity, the liquidity dimension of the system, is largely private. In normal times, it's about private dealers making markets. That's what I mean by saying liquidity is private, and it's global. Okay? But the backstop, the ultimate backstops, are these public entities, central banks, that are local. Okay, so the backstops are public and local, but the actual providers of liquidity in normal times are global and private. And so the hybridity and the hierarchy are really, these are dangerous waters that have to be navigated in order to create global governance. We've created this liquidity swap network at the top, the C6 swap network between central banks. Will this prove sufficient when it's really tested? Well, we will find out. We will find out. And will the Fed, as the ultimate source of the ultimate money in this global system, will they actually be able to serve as the global central bank? Will the political economy of the United States permit the Fed to behave in this way? We will find out. We will find out. It's not clear. we're engaged in a process of relocating and reorienting the liquidity backstop system away from institutions and toward markets, so markets not banks, global not local, liquidity not solvency, and also the similar relocation of this backstop for risk. So there's this model that I give you of shadow banking showing the centrality of the dealer function in money markets and risk markets. That tells you, where the backstop needs to be and who needs to be. We're relocating all of that, but it's not done yet. And even as it's being relocated, if we lean on it, we'll find out where it breaks. And so it's a work in progress. Global governance is a work in progress. I emphasize these things first, although if you read the newspapers, you would think that it's micro-prudential regulation, making sure each institution is solvent, or macro-prudential regulation. This is about nation states trying to control the expansion and contraction of credit. You don't hear much conversation about global regulation, okay, which is of the essence. It's a global system. You can make your own, any individual bank, as prudentially this or that as you want, but it lives in a world, okay? And if that world is unstable, it's going to affect that individual bank, even if they're as prudent as you want. And they can go away, because they're engaging with that world. There are no green islands in the global system. Not individual banks, not individual institutions, not individual countries. So it's this conversation that we need to be having to develop a more robust governance system. And in particular, needing also a robust dealer of first resort. There has been, since the crisis, some retreat from cross-border banking. Some of this is because of the nation state has said, I'm not willing to be the solvency backstop for a bank that's doing business in some other country. I'm only for branches of that bank that's in my country. It's the home bias. Home basis of regulation. I'm only responsible for the banks that are actually incorporated in my country. That has shifted around the incentives for cross-border banking quite a bit, headwinds to short-term capital flows. There's also been an attempt to make market makers hold more capital. That's caused a retreat from market making. So there's some people argue less liquidity in money markets and derivative markets. We're relocating and reorienting the dealer function, splitting apart the matched book dealer part, putting in a CCP. I talked about that last time, from the risk dealers. So the dealer of first resort system that is the first line of defense for creating global liquidity is moving around. The different institutions springing up, and it's not all built yet. It's not all robust yet. So hopefully we don't lean on it soon, because if we lean on it soon, we will go to the backstops very rapidly. There's not a lot of capacity in that system yet. So I point this out in almost every lecture, that we need a robust dealer of first resort, okay, in order to avoid going to the last resort very quickly. What you want is a robust dealer of first resort in order that it's only in the last resort, the really last resort, that you wind up hitting the public backstops. And the reason this is important is that a global system means that crises are global. In the Bretton Woods era, we had national crises. Post-Bretton Woods, there were regional crises. We talked about the Asian financial crisis and so forth. Now, I think we're going to have global crises. It's a global system. Something that is large enough to be a serious crisis, so that it gets kicked up to the top, is going to have global importance. It's going to affect everybody who is a member of this system. The crisis we had in 2007 and 2009, as I mentioned, was a crisis of the dollar money funding of dollar capital lending. It was about shadow banking, but in the U.S. mortgage market, so it was dollars on both sides. What I'm going to be suggesting is that the emerging new tensions in the system are going to emerge around the new kind of shadow banking that is dollar funding of foreign exchange capital lending. So that the foreign exchange swap market is going to be tested here. And you'll see, I'm going to give you some data on this and some pictures. Starting now. I've been Okay, so that's all the theory so far. Now I'm going to give you more empirical data and try to consolidate these ideas by talking about specifics, not generalities. The Bank of International Settlements has, in recent years, really the recent 2 or 3 years, not a lot of years, recent years, been writing a number of interesting papers, realizing that something very important has been happening since the financial crisis of 2009. The expansion of credit globally, at the level of the world, globally, has mostly been happening in the periphery, not in the core. Mostly so far in this lecture, I've been talking about the core, right? The dollar, the yen, the euro, okay? The center of the system, not the emerging markets, the periphery, okay? In the center of the system, credit to GDP ratios are more or less the same now as they were 10 years ago. There's not really been a net expansion of credit. There's been a huge expansion of credit in the periphery, and a very large portion of it has been dollar denominated. So there's this foreign exchange mismatch issue that has been rising, and it's been rising in the periphery. There's a couple of articles that Turner and Shin these are both from the BIS, have pointed out that in a large number of countries after the global financial crisis, we've seen a complete switch in the way that borrowing takes place. Okay, that pre-global financial crisis, that's what that means, sovereign borrowers were the only ones who could tap world markets, and they were like borrowing in dollar money markets and then on lending that money for domestic needs. So like that was what was happening in the Asian financial crisis, right? The sovereign borrowers are issuing dollar credits to global banks, and then they're swapping into yuan and lending to local merchants. So they're raising money in global markets and taking that risk. And local currency lending was for the business. Private sector was borrowing and lending in yuan, okay, and could not tap global markets, not global capital markets, not global currency markets. Which is why the sovereign was doing it. So the sovereign is standing in. Because your local firms, even very good firms, are not able to tap global markets, the sovereign is doing this and taking this risk on its own balance sheet, on the balance sheet of the central bank. That's why banking crises become currency crises for these countries, because the public sector is taking this risk on its own balance sheet. After the global financial crisis, this all swapped. It turned out that non-sovereign credits, okay, so private businesses, were able to tap global markets, global money markets, and also, as we will see, global capital markets. Okay. And because of that, sovereigns got out of the way and started issuing local currency bonds to their local population, and they were doing more of they were borrowing there. So there's a financial deepening that is going on in the periphery, that they're developing their own capital markets, they're developing their own money markets internally, and they're developing private sector access to global markets. So there's financial deepening and financial integration both happening in the periphery after the global financial crisis. As a consequence of the global financial crisis, actually. It's because the global financial crisis, as you may be aware, was not really a crisis of the periphery, okay? It was a crisis of the center. And the disorganization of the center, the credit constraints, the attempt to pay down debts in the center left a big vacuum into which walked the periphery. They said, okay, we're willing to borrow, you know, we're willing to give you positive yield when the yield in the core is all negative interest rate policy being driven by the central bank. So pension funds say, oh, that's what I want. I want a positive yield asset somewhere. So there's incentives on both sides. The emerging markets see this as an opportunity to enter global markets, okay, and global asset managers see this as an opportunity to get some assets that might actually conceivably pay some positive yield. And so they get together, and that's what this credit boom is about in the emerging markets. But it's in dollars. It's in dollars. This is what I want to emphasize. Here's another picture from another another paper from the BIS showing the kind of thing that's going on. We have non-bank borrowers, so this is private firms, for example, okay, that are borrowing. Some of this money it's showing is coming, in this diagram, showing is coming from the US. So this is the US border, this box here. And there are US banks that are lending $1 trillion. There's US investors buying bonds from non-bank borrowers, 1.3 trillion. So there's some money they're showing coming from the US to non-bank borrowers. But these numbers are bigger. These are people outside the US lending $2.7 trillion worth of dollar-denominated bonds, $3.7 million worth of bank lending in dollars to non-bank borrowers. So increasingly, the dollar borrowing action of the non-bank borrowers outside the United States is being funded also outside the United States. Okay. The majority of it, US dollar-denominated credit to borrowers outside the US is coming from lenders outside the US also. Here's another picture showing what it looks like in one particular country. Maybe think about this as Brazil, okay? This is me adding money market funding, but let's start here. So we have a non-financial corporation here that is borrowing in US dollars, okay? Some of that borrowing is inside the country. So this is the boundary of Brazil, say. So this is a country. Some of that borrowing is from inside Brazil. Some of this borrowing is from outside Brazil. This is the international capital market that they're tapping in order to fund their operations. International capital market. Call that capital market lending. And it's shaded box to say that it's US dollars. Some of this is coming from domestically, some of it is coming internationally. The other place where there's a shaded box is up there in the central bank, which is accumulating US dollars as reserve position. You've probably heard of this. There's big growth in the last 10 years in reserve positions of central banks in the emerging markets. So if you put these two things together, what do you see? You see capital market borrowing by the private sector and money market lending by the public sector. Capital market borrowing and money market lending. On the other side of that is somebody doing money market borrowing and capital market lending. That's shadow banking. That's international shadow banking in dollars for a country whose currency is not the dollar. Okay. This is the phenomenon that has been emerging since the global financial crisis, shadow banking internationally, that is relying on deep and liquid markets in dollar-denominated bonds and dollar-denominated funding, money markets, taking advantage of that. Present state of play. Here's some numbers, just to, that was a conceptual thing, an accounting thing. Here's some numbers collected again by the BIS. These are all separate little papers. A lot of my job as a professor is to connect the dots. That's what I'm doing here. So I connect the dots in this way. I will tell you this is not necessarily how the BIS connects the dots. I haven't even checked with them. There is no paper at the BIS that has the story that I'm giving you. There's just individual papers that tell you little pieces of the puzzle. And I've connected them in this way. Here we see, as I introduced you, the growth of credit in emerging market economies. This is credit divided by GDP, and this is 2006. So you can see sort of the financial crisis here and the growth of credit in the emerging markets and basically flat in the developed countries here. So that as it's just stylized fact, it's not too bad to say that essentially all of the growth of credit globally that has happened since the crisis has happened in the emerging markets. And this is showing some selected countries in the right. Here's another, these are too small for you to see them, but you can see that they all go up. These are individual countries. Poland is not one of them, so is not one of these 12 boxes. Some of them have larger pink sectors, this is bank loans. Some of them have larger blue sectors. Those are debt markets. So there are different kinds of dollar lending, but this is all dollar lending. This is not just expansion of credit in these countries. This is expansion of dollar-denominated credit in these countries. And they're all going up dramatically in this last 10 years. And we saw in the picture that there's also been dollar lending from these countries, this accumulation of reserve positions. And here's those pictures. This is an increase of China, Brazil, Russia, and India. EMEs excluding the BRICS, they're all going up, central banks accumulating. And what's more, if you compare this diagram and the previous one, they're the same order of magnitude. Okay. It's not that the reserve positions are the same order of magnitude as the borrowing in dollar, but these are public assets. The public sector is lending in the global money market. The private sector is borrowing in the dollar capital market. That's what's happening in the emerging markets in general. Which makes the BIS worry. The BIS worries. We saw last time paper from Carlo Borio, research department. The BIS worries in general whenever there's expansion of credit, okay, that there's too much credit and it's going to collapse, okay, and they worry about mismatch, that if there's too much credit and it's in a foreign currency, movement of exchange rates can collapse. This story that I'm telling you that connects these things together and says what's really happening is foreign exchange denominated shadow banking, and the way it will help you understand what we should worry about in the collapse, which is dislocation of global money markets, just as happened before with the collapse of subprime. That's the subprime mortgages. There were not that many subprime mortgages in the US, actually. The US mortgage market is enormous, and the subprime part is a tiny, tiny little part. So many people thought, when the subprime market was collapsing, this will have no systemic consequences. They'll just all collapse and people will take some losses and that'll be the end of it. But it was not true. And the reason it was not true was because of the way those mortgages were being funded. They were being funded in global money markets. And so when they collapsed, they disordered global money markets. And when they disordered global money markets, you're talking about the infrastructure of the global economy. It's like the roads don't work anymore. The economy comes to a halt. So subprime was small, okay, but if the roads don't work, nothing works. So this is how I'm pulling together the dots for what's going on in emerging markets. That it may not be a large number compared to the global system, okay, but it is definitely a big enough number that if there were problems there that disrupted the global money markets, that could disrupt the global money markets, this is going to reverberate through the whole economy, and that's why I would pay attention to it. Because money market funding of global market lending requires continuous liquid markets, both in funding and in lending for the collateral values. I look at this through the lens of my great hero, Charlie Kindleberger, who I mentioned to you before, was concerned about the breakdown of the international monetary system after Bretton Woods, that this might lead to another depression. He was led to be, a little bit before that happened, there was a lot of noise being made by a professor at Yale named Robert Triffin, Belgian economist, about how the dollar was weak because the US was running a balance of payments deficit in order to provide liquidity to the rest of the world, and this was called the Triffin dilemma. The world wanted dollar-denominated liabilities, but the only way it could get it was for the US to be a deficit country, and as we know, money view idea, that's a weak position. It gives you have to give liabilities that your creditors want. Kindleberger responded to the Triffin dilemma saying, no, the dollar's not weak, the dollar's strong. And you don't understand how dollars are getting into the system. They're not getting into the system by the US running a trade deficit. That's not the main mechanism. Yeah, the US is running a trade deficit, but let's just ignore that for the moment. This is the way they're getting into the system. The US is lending long. Europeans, the deal was really Europe versus the US at the time. Europe is coming to New York, coming to the US to borrow from our banks, loans, borrow in our credit markets, bonds. Okay? And they're keeping some of the proceeds on deposit in the US also. Well, they're keeping them on deposit in their banks, okay, in Europe, which are keeping them on deposit in their central banks, which are then holding reserves in the US. So, but yes, as a matter of the relationship between nations, the US is acting as a bank for the world. It's borrowing short and lending long to Europe. And Europe also is on the other side of that transaction. It's borrowing long and lending short. And both sides of this transaction are gaining. Europe is borrowing in the US because the US has deep and liquid capital markets that Europe does not have, so they can borrow more cheaply. And they're holding dollars as the world reserve currency to facilitate their trading and so forth. Everyone is doing this willingly. The dollar is strong, not weak. And the source of dollars that are being held as liquid reserves by Europe is not the trade deficit of the United States, okay? It's just expansion of the banking system of the US on both sides, expansion of that balance sheet on both sides. You can expand that balance sheet on both sides if the US is running a surplus, a deficit, or a neutral position. It has nothing whatsoever to do necessarily with the balance of trade. Okay, I just want to remind you of this argument, okay, because it's relevant for the financial crisis most recently, and it's relevant for the next one too, if it comes from emerging markets. Let me just show you the next slide. One way to think about what was happening in shadow banking was that it was the reverse of the position that Kindleberger was talking about in 1965. Okay? The European banks, I mentioned to you before, it was a round trip. They were running shadow banks on the balance sheet of UBS, the Universal Bankings, and Deutsche Bank, and so forth. They were borrowing short and lending long. They were borrowing in world money markets and using those proceeds to invest in residential mortgage-backed securities, which are issued by the US. Dollars on both sides, borrowing short and lending long. And the opposite side of that transaction was in the US. The US was borrowing long. The private sector was issuing mortgage-backed securities, and various cash pools and other U.S. entities were putting their money into money market mutual funds that were funding these things. So the U.S. as a whole is borrowing long and lending short. That's the opposite of what was happening in 1965. It's this that got challenged by the financial crisis. The shadow banking system that was booked in Europe collapsed. And it collapsed onto the US banking system, Citibank and whatnot, and then onto the balance sheet of the Fed, the expansion of the balance sheet of the Fed that we saw. That was the global financial crisis. We talked about that. What about the future? This is what the future, this is the set of balance sheet relationships that I've just shown you is emerging. In the emerging markets, the way they're borrowing long and lending short. Right, that Brazil, most emerging markets are borrowing in dollars, borrowing long and lending short. So they're borrowing in, these are loans, these are bonds. I showed you some countries are mostly loans, some are mostly bonds, and some of these central banks are accumulating more reserves than others, but in general, the emerging markets are borrowing long in dollars and lending short in dollars. And who are they borrowing long from and lending short from? Not the United States, okay? Everybody but the United States. Non-US ROW, rest of the world, okay? Which is Europe, but also Asia, so there is a position like this, money market funding of capital market lending, shadow banking, okay? The shadow banking kind of structure that is on national balance sheets outside the emerging market in Asia and in Europe. Okay. This kind of balance sheet is exactly what got challenged in this crisis and broke. And the solution was to move it all to the Fed and to the US. This kind of balance sheet is going to come under pressure again. Okay. But if it breaks, who's going to grab it? Given that the US is on neither the lending side nor the borrowing side of this. The political economy of the Fed acting as backstop for the global dollar system outside the world may not work. May not work. This is what I would be concerned about, that we have been developing these exposures globally. So it's not going to be direct. It's going to go through foreign exchange swaps. That's what it's going to be. That the central banks of the countries that have this position are going to be called upon to be the backstop of this system. Okay? And they are going to activate their swaps or with the Fed or something, and it's going to show up in the foreign exchange swap market. That's, as I connect the dots, that's looking forward what I would be concerned about. We talked about this sort of thing. I'm just extending the issue about liquidity in a matchbook world. Everything I said last time about shadow banking now applies, but adding in this issue of foreign exchange swaps and how changes in valuation of foreign exchange swaps are going to cause collateral flows, and if those collateral flows are not smooth, there can be liquidity spirals, there can be problems. The global money is inherently unstable. This is just to remind you. There's an expansion, and in the expansion phase, credit begins to look like money. Okay. In the contraction phase, there's a reassertion of hierarchy, that money is different than credit. Credit is a promise to pay money. There are a lot of promises to pay money out there. There are a lot of people promising to pay dollars. Okay. At the end of the day, when the hierarchy reasserts itself, there's a specific thing that we mean by the dollar, okay? And it's liability of the Central Bank of the United States, okay? But all of this stuff is being built up outside the United States, and the settlement discipline, when it comes, okay, will test. Are you actually able to settle in dollars, okay? Or are you not? And that's the nature of the system. Expansion, and then contraction, reassertion of hierarchy. This is my last slide. So, what is at stake here? I don't want to be too doom and gloom, because I think we can sort this out. I think we will sort this out. You know, the international financial system has been through hard times, and it's just, these are new challenges, and it's best to just confront them and to say, here's what the challenge is going to be. This is a passage from Sir John Hicks, in an article he wrote in 1967, Monetary Theory and History. He was concerned that Bretton Woods was collapsing, okay, at that time, in that timing, and he was concerned that that would lead to a destruction of the destruction of the international monetary system would lead to a destruction of the global trading system and a return of Great Depression. Not unlike what I said Kindleberger thought. So he thought we were trying to avoid this, and that's why he wrote this article. He says, what is liable to happen if there's a failure of international credit is that nations will turn in upon themselves, becoming more autarkic and more protectionist, impoverishing themselves and each other by refusing to trade with each other. We hear political echoes of this, right, today. This tendency is there. It's real. The remedy would be an international central bank. An international bank which would underpin the credit structure, but in order to underpin it, it must have some control over it. That was what Keynes, who understood this international aspect very clearly, wanted to get at Bretton Woods in 1944. All he got was a currency board, okay, the IMF. Today, so this is 1967, coming out of this breakdown of Bretton Woods, one of the things that happened was the expansion of the credit capacity of the IMF a little bit through the SDR. The SDR was invented there. But the most important thing that happened, as I said, was the expansion of private banking through the Eurodollar system and associated interest rate swaps and so forth. It took about a decade. The 70s were not a good time to be alive. Okay, it was a stagnation period in the global economy as we were getting the infrastructure together to get this thing going. And then the 80s were quite different, returned to some sort of international growth. We're confronting this sort of thing now. Okay. What we have to work with here, what I would focus on, is not the IMF, or expanding the SDR or anything like that, but this network of liquidity swaps between central banks. this network of private dealers making markets in foreign exchange swaps. This is the infrastructure that is operating as a kind of international central bank. Okay? The global governance challenge is being managed by a committee of central banks, okay, as opposed to a currency board. Well, is this better than a currency board? A currency board is unable to expand its balance sheet. This is the point here, and that's why it's not adequate to serve as the lender of last resort for a global system. The system we have now is able to expand its balance sheet. Okay, the central banks are banks. Okay, private dealers can expand their balance sheet. There is elasticity in the system. However, it's not global. It requires people cooperating, doing their jobs. We will see. This will be tested. It's being tested, and this is where we are in history, and it's an interesting moment in history. So I await further developments every morning. I get up and read the Financial Times and see what's happening now. Study international monetary economics, study monetary economics, period. You'll never be bored. It's a big drama. The drama doesn't happen every day. There's long cycles, okay? But watching that I have found to be quite fascinating. So that's where I will leave it for now and see if there are any comments or questions. We have about 10 minutes left, our last 10 minutes before I fly away. Piotr?
So are there any questions? I was wondering about according to the major markets, and for instance, I was wondering if there would be a rise in interest rates in the United States. Would this have an impact on credit emerging markets and shift? The difference between interest rates in, for example, Brazil was smaller with the difference interest rates in the United States, which is a shift from credit dollars to borrowing to the rise of borrowing in local currency. And would this double the impact if a local central bank raise the interest rates elsewhere? How local central banks should take into account decisions by the Fed?
Okay, so the question, just to repeat it, is he is observing that the Fed in particular is talking about exit from this period of quantitative easing, of accommodation, of very low interest rates, however you want to look at it, the various indicators of very loose monetary policy. They're talking about contracting their balance sheet, they're talking about raising interest rates, and so are other central banks, major central banks around the world, sort of in concert. They're all talking about this as a new stage in monetary policy looking forward. And some of them have actually begun a tiny bit, okay, but it's mostly in the future here. When central banks do this, you know, this credit structure, as I say, hierarchical credit structure, has been in expansion mode, elasticity mode, and now it's moving into discipline mode. This discipline mode is being, at least initially, caused by the central banks, not by the system itself. If the central bank didn't do anything, it would eventually expand too much and then collapse on itself. That was what we learned before there were central banks. And so the whole purpose of this is to try to stop this expansion or slow it down before it gets too nutty. Okay, that's sort of the idea. But the question for people living in Poland or emerging market countries farther out is, how is this going to affect me? Okay, and so that's why I want to just draw I put back to this picture of the international hierarchy of money and credit. That what's happening is that the center, okay, has decided to, or all of the C6 basically are all moving into contraction mode, saying we're going to be raising interest rates. Some of this I think is very useful and necessary and maybe long delayed, part of shifting from having the central banks being the market maker of first resort to having private sector as market maker of first resort. As long as central banks are keeping asset prices unreasonably high, no private sector is going to want to make markets in that. And so you need to, the infrastructure of a market economy should not be the central banks as your first resort, but only as your last resort. So one of the things that's happening is we're shifting from, trying to shift toward a more robust first resort infrastructure, and that's a good thing. But it's going to be a rocky thing, and asset prices are going to change and adjust quite considerably. How considerably, we don't really know. We don't know what the market rate of various things are. We don't know what the market rate for bonds, for stocks, for various currencies. We will be finding out, and that's what you're asking. What I would remind you is, where is Poland in all of this? Okay, is natural question for this location. That Poland is connected to the global system largely through its connection to Europe, okay, to the ECB. And so the real question is, what is the implication for what's happening at the Fed for the ECB? What are they going to be doing? And how is that then going to... So there's two layers here, not one. Poland is not directly related to the Fed. And there's two ways in which shocks get absorbed in the modern system. One is by credit expansion to absorb the shock, and the other is by price movement to absorb the shock. So you're asking how much of this is going to be absorbed through replacing global credit with local credit, and how much of it is going to be price movement. And there'll be a little bit of both. I think there'll be a little bit of both. And that's a balance. But the system as a whole, I think, is moving into reasserting discipline after a period of elasticity. And I think that is actually a good thing in the sense that in periods of elasticity, lots of credit misallocation happens, and the discipline that creates coherence in the market system falls by the wayside. So it's not bad that every now and then we look back at our investments and say, was that a good idea or was that not a good idea? And if it was not a good idea, let's stop doing that. Let's not do that anymore and use our resources where they're more productive. That's what we're moving into. That will mean higher rates in local markets. I'm not sure that it will necessarily, in money markets is what I mean. Not sure how much of that will translate into longer term markets. Long-term rates have not, in general, moved negative except for sovereign credits. And if you look at what the rates are in emerging markets, maybe that's a sign of what the market rate of interest is. You know, where credit has been booming, and there will be a reconnection of the policy-driven advanced world with the more market-driven developed world. I think, I don't want to kid you, there will be dislocation, it will be rocky. But if you keep the big picture in mind, I think there's no reason to freak out. And we will be testing some of these backstops in this process too, and some of them will break. And again, if you keep the big picture in mind, there's no reason to freak out. You should expect some of them to break. Some of them are new, and then we will fix them. Okay, this is the nature of the way the system evolves. It expands, it contracts, it breaks, you put it back together again. It's exploring new parts of the state space all the time, and we are definitely in land that we've not been in before. So, and we are building things that we hope will work, and now we're going to see if they will work. It will not happen tomorrow, I don't think. We're talking about the next couple years. As things slowly, because the central banks are not moving quickly. They're moving very slowly. Perhaps they're moving too slowly. And there may be some appointments at the Fed that will make things move more rapidly. We don't know. This is what we're watching. I don't know if that gets to your question. Anything else?
Okay, I think we should end right now.
Oh, look. Do I get one of the pins?
Yes.
Oh, fantastic. Yes.
So thank you very much.
Thank you very much.
I think all students would like to thank you, and those are small gifts for you to remember Poland and our university.
Thank you very much. Oh, money. And the book.
Thank you very much.
Thank you very much. Thank you very much. Thank you very much.